you talk about in the book about when to sell mining stocks. You talk about the 5 commandments for a mining stock investor. Now, I know we don't have time to do all 5, but there was one that really stuck out to me, which is number 3, which was no chasing. And as part of this, you talked about how you were bitten by the FOMO bug in 2006 when you chased this uranium stock and soon found out that you'd bought in at closer to the top than the bottom. So I think this is such an important trend, especially in an age characterized by traders who chase momentum and growth stocks as opposed to value-focused contrarian plays. So perhaps you could expand on the lessons you learned from that no chasing rule and any other lessons you learned from your investing career as well.
You know, the no chasing rule is actually easy to follow right now because not a lot of things are moving, right?
Yeah.
But you will see stocks that or companies that report good news and the stock will jump 20%. It's on days like that where you don't want to chase because there's always pullbacks, especially with huge gains in one day, right? So it's easier to follow now. What I think is going to happen at some point, though, we're going to get into a bull market, and then it'll be a raging bull market, and then the possibility is high, in my opinion, that we go into a mania, and that's when people will chase. We'll see a lot of new people coming in, and you just gotta. At that point, you don't want to chase, but you want to hold on for your life, and then we'll be exiting at some point. In the middle of that mania, hopefully. Yeah. But it's easy to follow right now. And I do use stink bids. I really encourage people to use stink bids to, if you're looking to buy a stock, just bid slightly under the market. Don't buy at the ask, especially for a junior, because there may be a 20% spread there, and you do not want to do that. And in the current market, even though volatility is low and volume is low, although volume is picking up, that's another clue that we might be getting started here. But generally speaking, volumes historically are still low right now. So you can use a stink bid and, you're not going to get something 50% under market unless there's company bad news, then you don't want it. But you might bid like 5% under market, something like that, and just get someone who's, ready to sell. And we're in September already. The year's going fast, but we're going to get to a point where we have some tax loss selling too, and there will be tax loss selling this year. So I would target, have your watch list, but target the companies that you might have your eye on if you don't expect big news, by the end of the year that you might want to pick up on a tax loss selling event.
I see. Yeah, that's good advice.
How I would view all this, Ted, is, gold is like your grandpa. Steady, strong, friendly, always going to be there for you. That's true. That's what gold is. Yeah. Gold stocks are very different. They're like your cousin or whatever, they're going to be volatile.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the 2 most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode.
But use volatility to your advantage, absolutely. So yeah, that's kind of how I view the sector. Gold and gold stocks are very different, so just keep that in mind. If you don't have a material amount of gold, I would buy on dips. And by material, I mean you have to own more than 5% of your portfolio in gold. I personally have roughly 20%, and that's based on research from history. If you own less than 5%, it's really not going to make a material difference if things go wonky. So I would encourage people to invest more in their grandpa if they don't haven't already.
Which is hilarious at a time when I think around 1% of family offices have a commodities allocation in general. I think it's starting to rise slightly, but it's still crazy when you think about the scale of the opportunity. And